on board Mittul Kalawadia, who is the fund manager of ICICI Pro Dividend Yield Equity Fund. So let's bring him on board and understand more about this fund and his current views on the market setup. Mittul, good evening and welcome to the show. And I will ask you about the fund, and we'll know the exact allocation and how it is important for investors to have this kind of fund in the portfolio. But then before that, what are you reading about the market?
Yeah. See, in terms of macro setup, if we see from an India perspective, then there are not many negative things that you can now talk about. So there was a time from October 21 till now where there were some uncertainty which on the macro front, which actually created volatility in the markets. Now, most of those uncertainties are behind, and there is more certain about the chain of events that will play out. Either it is in terms of, let's say, the commodity prices where they are, or if you look at the current account deficit, which is a concern for India, all those concerns are no longer a big concern to be worried about. And then if you talk about US interest rates and all, there also the trajectory of the chain of events is more or less certain. So the uncertainty in the market has gone down, and not in markets, I'm saying in uncertainty on the macro events has gone down. And that should essentially mean that overall markets, if there is a good earnings trajectory over the next 4 quarters, then market should be in a good shape. So of course, there will be some volatility within the markets, which is the basic nature of the market to be volatile. So it's not always a runaway market which we expect, but we expect more of a moderate return markets and after a long period of consolidation, which we have seen in the past 1.5 years.
All right. Even if we exclude the scenario that we are, or the booster that we are getting from the FII's end, you still think that we are on our strong grounds?
Yes. So, see, the current account deficit has come to again a comfortable zone where our currency will be more or less in a stable zone. And any stable environment is good for businesses because then the predictability of pricing, either on purchase or on sales, is always high. So, exports and imports both can happen at a regular pace without much volatility. And when there is lesser volatility, it also means that people can predict their margins, plan their business operations in a much advanced way. So overall, it's a good scenario to be
into. All right, Mithul, let's talk about your fund now, and let's help our viewers understand what's the kind of strategy you've adopted in the fund. So, ICICI Dividend Yield Equity Fund. Basically, what's the idea behind any dividend yield fund? Let's just start with this.
Sure. See, generally, when the term comes like a dividend yield, people think this is a like of kind of a very safe fund, a fund which will be investing into high dividend yield companies. And that essentially means that also the indirect meaning of this will be that it will be a low growth or a kind of a no growth kind of a fund where the companies will be actually at a mature stage of businesses where they don't need so much of money, so they are paying dividends. And you would earn returns which will be nothing but yields, dividend yields out of these stocks, and there will be hardly any capital appreciation. So that's general, I think, a popular thinking which everybody would have. But the way we run our dividend yield fund is a slightly different one. And if I were to summarize for all the viewers in a very simplistic manner in a one line, then our dividend yield fund or the way our strategies is, this is more like a diversified fund which invests into various sectors, various kind of market caps of this economy. And at the same time, this is a fund which is run based on an approach which is called as a sustainable yield approach. Now, what is this sustainable yield? If I were to put it in a very simplistic way, you try to look at stocks which have a very high dividend yield or a cash flow yield, and then you eliminate some of the stocks based on the sustainability of their dividends and cash flows. And in this elimination process, you try to rank stocks with a higher or a better growth prospects, along with the stocks with the stability of their dividends and cash flow. Those kind of stocks, you give them a higher weightage in your fund. And in this way, you create a portfolio which is a combination of bottoms up and bond quantitative analysis. And this is how you create an overall portfolio which will keep changing over a period of time depending on what is relatively more attractive at various point of time in market.
All right, let's talk about your exposure in different sectors and accordingly your exposure in different companies. Sustainable dividend growth, that's what you mentioned, also with a diversified approach.
Yes.
Looking at the current market scenario, what are the companies that you're betting on? What are the stocks in terms of sectors? You can't be talking about stocks, I guess. So,
Yes.
what specific sectors are you looking at? And within those sectors, what kind of companies are you looking at for better sustainable growth when it comes to dividend to your investors?
See, one of the big, most positive sector that we you can see or in terms of weightage in our portfolio is the power sector. There are a couple of power companies, both on the generation as well as some on the capital goods side, which is part of our portfolio. And this is based on a very simple, longer term understanding of how the sector is performing in terms of its cycle. If you look at the power sector, then there was a cycle in the power sector between 2000, let's say 1 to 2012, where it was constantly in a deficit market. There used to be huge power shortages. There used to be huge power demand which was unmet, and that defined that decade of power cycle. Then what happened? A lot of power supply was being planned because the rates were high, the ROEs were high, there were policies which were favoring more generation. So those power plants then, and it's a long gestation period, so it takes around 5 to 8 years to get up a power plant up and running. And by 2015, the sector started to see an oversupply, and then we saw a continuous from 2015 till 2020, we saw an oversupplied market. And that depressed the earnings of all these stocks, all these companies. So, and a lot of companies failed to survive in the sector. Ultimately, the sector got consolidated and now it's up. And over this long period, slowly and steadily, the demand kept on increasing. And demand is very simple in terms of energy. If you see, with there is a high correlation with GDP growth. No country can grow without an appropriate source of energy. So demand continued to grow along with our GDP, and it would continue to grow. So and this is where if there are no more supplies being planned in the manner which will take care of peaking power deficits, then again we will see a couple of years of good investment opportunities for the sector. And that is why if you look at some of these stocks people thought were completely unattractive. People thought it will be a low growth sector, absolutely no interest in the sector. Along with that, there was a one more event which affected the sector, which was ESG in 2017, 18 to 20. A lot of global funds started adopting ESG, and a lot of thermal power plants in India became an unattractive opportunity for them. So they started exiting some of these stocks, and these stocks became a very attractive investment opportunities for the investor. So we like this sector today. Also, if you look at the valuation of the sector, some of these listed power plants are still trading at much cheaper compared to 2008 peaks. So something like some of these generation power plants used to trade at 2.5 to 4.5 time price to book in 2006 to 8 period when there was an upcycle. Today, these are still at around one time price to book or below, and attractive yields of upwards of 2 to 4% in many of these stocks. So it's a very interesting sector. Now these companies have addressed the ESG issue to some extent. Many of them are investing into green renewable energy source. So those issues are not so much of a worry, and at the same time they are enabling India's growth engine. So we think it's an
What is
important
the
sector.
right? What is the benchmark that the fund is tracking, and what's been the dividend yield?
So the benchmark which the fund tracks is NSE 500. So it's a broad index which is kind of used for most of the flexi cap or a diversified kind of funds. So broadly, that's the benchmark which generally gets used for most of the dividend yield funds now.
So far,
If you
yeah,
yeah.
yeah, yeah.
Sorry, if you look at Nifty's dividend yield, it's something around 1.5%. That's the kind of index dividend yield in on a broader.
But Mithul, if the markets have been very volatile, that also we've seen in past few quarters, these funds really won't help you make a lot of money, right?
No, actually, if you see the only scenario where these kind of funds have a slightly more volatility and a challenging time is the uncertainty of whether there is a recession or no. So it's only during those recession time it becomes difficult to predict what will be the cash flow yield and what will be the dividend yield which will be sustainable. But apart from that, generally, this strategy of looking at a sustainable yield has been a good across all time periods or across all phases of economy. They tend to do well in the recovery phase of the economy. And at the same time, in a stable environment, also, there are always good opportunities which keep coming here. Just to give you some small example, like if you look at today, the high yield stocks or the high yield framework based sectors versus the low yield, which is generally the high growth sector today. The high growth and the low yield stocks are still pretty expensive compared to their past, even after a good time consolidation or some correction of prices which has happened. Actually, either there is some disappointment on growth side or disappointment on some profitability side, which has led to some of these stocks continue to remain very expensive. Whereas if you look at the other high dividend yield and the high cash flow yield stocks, they are really still attractive despite fantastic returns that they have already generated in the last 3 years. Despite that, the valuation gaps between the two remain as it was in 2.5, 3 years back. So we still think that it's a very good investment opportunity for investors to look at high yield or a high cash flow yield, dividend yield kind of a framework of investing.
Mithul, now this type of fund is definitely not the one that you want in your core portfolio. This can be like an added diversification. There has to be a certain need to have this kind of a fund in your portfolio. So, who exactly should be investing in this kind of a fund, and also what's the tax implication for this kind of fund?
Sure. See, I'll answer it a bit differently. I think this can be part of your core portfolio. So, if you were to slightly take a slightly broader approach and think about it, this fund is very similar to what you see in all the other flexi cap or a diversified kind of funds, right? It can invest into large cap, mid cap, small caps. It can invest into all kind of diversified sector. And if you look at our sectoral diversification, also you can find most of the sectors having representation in the fund. So it can be part of a core portfolio with it actually adds to a differentiated style. Most of these flexi cap or a diversified fund will be either a pure value or a pure growth. Here it's a more of a blend approach between the two. We try to marry some growth into our portfolio through our sustainability factor, and then there is a value angle which comes through your high yield factor. So there is a blend of both which works over here, and I think it can be a part of a core portfolio rather than just being an added here. Coming to the sorry, what was the second part of the question?
The tax implication. Yeah, yeah.
So coming to the tax part of the overall discussion, see. For mutual funds, when they receive dividends, it's more of a trust structure because it's not our money, it's the investors' money ultimately. So those tax structures are having a tax advantage. They don't need to pay tax on those dividends which they have received. At the same time, when the investors have invested, and since these money get redeployed into various stocks again, there is no implication of tax on dividends for the investors which we receive from the companies. Now, if an investor has invested into a growth NAV, then as long as they continue to remain invested into those funds, they don't need to pay those tax. So in some sense, it is more a tax efficient form for an investors who are more longer term investors with a longer term horizon. And we think it's a good way to invest into dividend yield.
All right. Thank you so much, Mittul, for being on the show and helping our viewers understand this particular fund and the category that's useful for the investors for their portfolio. Thank you so much for being on the show. On that note, let's. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and let's talk about credit cards. Credit cards have become one of the most popular ways to spend money. They come with a predefined credit limit that can be used to make purchases. However, initially, credit card issuers offer a lower credit limit depending upon factors such as credit score, current income, and more. But once you start using your credit card and pay the dues on time, credit card issuers often increase your credit limit. But the big question here is, should you be opting for a higher credit limit? Let's understand all of this with Ameet Venkeshwar, Chief Business Officer of LoanTap. Ameet, good evening and welcome to the show. So a very important question for a lot of people, people who have only one credit card or whether who have more than one. A lot of people use credit card as emergency money. So having a higher credit limit is obviously something that they want. It's on their list, but then initially are not offered. But then what is that stage or that threshold when you reach somewhere, maybe in your financial life, it is important for you to have a higher credit limit?
So typically, a finance institute will lend about 2 to 3 times of your monthly income. That's a credit limit that's been offered. The kind of credit limit that an individual requires is not more than 25 to 30% utilization, which is about what his monthly income is. That's the way you can maintain a discipline. But it's also an emergency money which everyone would like to have it, and that's why the reason is not more than 3 or 4 times of your monthly income. That's the limit that you should look at in terms of your credit card. Either it's broken into multiple cards or a single card. It does give you an advantage in terms of higher limits in terms of your loan and all, which will enhance your points on the bureau as well.
So once you have a higher credit card limit, first of all, it's how important it is for you to have a higher credit card limit. What should be the justification behind it? I mean, a lot of people in India also have more than one credit cards, and if you are that person, should you be having a higher limit on all your cards or just one is enough? Because you also have to figure out a repayment strategy if you've been using all those credit cards.
Yes, having a limit is not an issue in terms of your card, but maintaining that discipline because the availability of credit and running it out. So the ideal
Right.
situation is you
So,
need to
Amit,
break.
the question also is how much is enough and how much is higher? How do we decide that?
So it's about the cash flow, right? So as I said, my monthly utilization, if I understand, if my card, if I have single card or I have 2, 3 cards, if my utilization is within that 25 to 30% range, then I am well off. If my monthly transaction is going, say 50, 60%, yes, I am looking at a riskier side in terms of debt and managing that. So your limit will always have, a ceiling of 4 or 5 times of your monthly income. That should be an ideal situation to break it up into your.
Okay. Also, what's the right approach, Amit? Because what happens is all these banks, they track your financial behavior. Okay, if they see you as a person who's been using a lot of plastic money, they might offer you a higher credit limit, out of the turn. I mean, even if you don't deserve it, even if you don't want it, they will come and lure you with that. Should that be the case, or you will analyze all your expenses, and if you think that you fit in that particular category where having a higher limit is okay, you can approach the bank. How will the bank read that kind of an approach, or how do they assess your demand for a higher limit?
So again, plastic has been used extensively. So
Right.
banks do track your transaction and your repayment record, but also utilization. That's what I said again and again. That's an important factor. If banks see that you have been utilizing almost 70-80% of your limits, even though you are paying on time, that's not an ideal situation in terms of increasing the limits by much. When somebody is using continuously and rotating his card payments at around utilization of 40 to 50%, that's an ideal situation because that gives a comfort to the financer also that this guy is not going overboard and is managing his finances well. So that's the trick in terms of running, getting a higher limit of cards with the other funds.
Also tell me what kind of an impact it has on your credit score. Now, if someone has asked for a higher credit limit and has more than one credit card, uh, uh, your credit score impacts only when you fail to pay the money, right? Or does it also impact when you are inquiring for a higher limit?
So, credit score will not get impacted if you have a higher limit card, but yes, it helps you get bigger limit loans and all because you have demonstrated a track in terms of having a card limit of higher amount. Score will not get that much impacted, but yes, it adds certain points in the bureau score which will enable you to get higher loan.
Important to have a disciplined approach if at all you're using one card with a higher limit or you have multiple credit cards. Always have a repayment strategy to pay back that money, and also assess the kind of expenses you have if in case you're the person who is demanding for a higher limit. Thank you so much, Amit, for being on the show and helping our viewers with that. Thank you.
Thanks.
And we move on. We at the Times Network are back with our flagship event, India Economic Conclave, which is known to set the stage for driving India's economic agenda as we move forward on the path of integrated, equitable development, which is all-inclusive, all-pervasive, universal, and one that strengthens not just the Indian economy, but the global one as well. To pursue this agenda, the theme for this year is India, the emerging third superpower. IEC will feature the biggest voices from politics, global markets, economy, and corporate world. So get ready to catch all the action here on Times Network. And then post that, let's help you plan your financial portfolio keeping inflation in mind. We'll be having Feroz Aziz on board, and also we will discuss your portfolio strategies after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and with me I have now Feroz Aziz, Deputy CEO, Anand Rathi Private Wealth Management. Feroz, good evening. Welcome to the show. And before we talk about inflation and its impact on your investments, I have a viewer that's joining in from Dubai and wants to ask you his question. I have Tony from Dubai on the phone line. Tony, hi, good evening. How are you doing?
I'm doing good, Kavita. How about you?
I'm doing good. Thank you. Thank you so much for sending us your query also. Is there anything else that you want to add to the question that you've already sent?
Yeah, maybe I'm 33 years old. I don't know if I put that in the message, but yeah,
33.
I'm looking for a horizon of maybe 25 to 27 years.
Sure,
yeah.
Sure.
And an investment horizon of 25 to 27 years. Yeah.
Okay, and you want to increase your SIP with 10,000 more, and you want to add a mid-cap fund. Any particular reason why you want to have a mid-cap fund? And the existing funds that you have in your portfolio, Tony, is this your research-based fund, or you're already consulting a financial planner?
No, it's all by myself. So
okay.
Yeah, the 4 funds that I have chosen at the moment, it is all by myself, yes.
All right, so let me just confirm. It's Parag Parekh Flexi Cap, UTI Nifty Next 50, Quant Infra, PGIM Small Cap, and now you want to add a mid cap fund. Any reason why you added a Quant Infra fund?
Yeah, I was going through the selection of the stocks under this fund, and it looked a bit attractive to me. That made me to select this one. I don't know if it was the right decision, and that's what I'm trying to figure out from the experts. Yeah.
Tony, any corpus that you want to accumulate in this time period, 15 to 20 or 30 years that you've mentioned?
Yeah, some between 25 to 30 years. I'm looking at maybe 20 to 25 CR.
20 to 25 CR. All right. So
Yeah.
let's
So
ask.
currently, I'm investing 80,000
Yeah.
put together. I
Yeah.
hope you have the details, right? Yeah.
Yeah. Yeah. All right. So let's connect Feroz now. Feroz, how are the funds looking?
Yes, Kavita, there are several things. Of course, the funds need some change. Firstly, Tony, coming to the mother question, which is, will you be able to accumulate the 2025 crores which you intend to? The answer is a yes. Because you're 33 years old and you might have some debt in instruments anyway, in the form of bonds and stuff. So from this SIP standpoint, if this 90,000 rupees were to be invested for 30 the consistent years, month on month, if the rate of return you expect is 14%, you will be able to grow this money to almost about 50 odd crores. So that's the power of compounding. So that's point one. Of course, 50 crores might sound very large today, but 30 years from now, its value would be equivalent to 8-10 crores of today. But it's still going to be a handsome amount. So that's point one. Point two, you have 4 schemes. You need more schemes. That's my first initial reaction, because you're not investing 5,000 rupees. You have enough corpus to actually have 8-10 schemes in your portfolio. That's point two. Point three, coming back to Kavita's question, are the schemes good? I think I would recommend you to exit 2 of them. If you don't wish to exit because your installments would have been going on a recurring basis, you could probably stop the further installments and then remove these 2 funds, accumulated units after the exit load periods are over: UTI, Nifty Next 50, and Quant Infra. Having said which, then since you're a Dubai resident, there is also a dual taxation treaty between India and the UAE, which makes mutual funds tax-free for a Dubai resident. So if you take a TRC, which is nothing but the tax residency certificate, you'll have to go to the Emirates IDs and you have to go to those Emirates office and take a TRC for yourself. It has some 1 lakh rupee cost per a certain period. Then your mutual funds in India become tax-free, and even the TDS deduction becomes exempt to you. So that's one thing which I want you to keep in mind, because that's a huge advantage of living in Dubai. Coming back to the schemes which I can read out to you, which is a laundry list of them, you can make note of those, and you can have probably 10,000 each rather than having 25,000 in any of those. HDFC FlexiCap, ICICI Focused Equity, SBI Contra, SBI Large and Mid Cap, Franklin India Blue Chip, HDFC Small Cap, ICICI Pru Dividend Yield Fund, Kotak Emerging Equities, and Kotak Multi Cap Fund. So these are the schemes which you can surely look at adding into your portfolio and subtracting the 2 which I just mentioned.
All right. Tony, is there anything else you want to ask?
Thanks, Feroz. I just wanted to ask, so he recommended me to do a 10K investment on all these funds rather than going with 25K or a bigger amount. Did I understand that correctly?
Feroz?
Kavita, I couldn't hear Tony very clearly. If you can tell me what was his question.
Can you repeat the name of the funds once again, Feroz?
So you want the repetition of the names of the fund?
Yeah.
Of course, HDFC FlexiCap, ICICI Focused Equity, SBI Contra, SBI Large and Mid Cap, Franklin India Blue Chip, HDFC Small Cap, ICICI Pru Dividend Yield Fund, Kotak Emerging Equities, and Kotak Multi Cap Fund. These are in total 9 schemes, and you have 2 already, even if you exited the other 2. I personally think even a 10-11 scheme portfolio for your kind of SIP amounts will do justice, because funds are cyclical. So it's important to diversify them optimally.
Tony, these are all equity-based schemes, and Feroz, if he wants to increase his SIP, step up his SIP by 10,000, what fund should he be selecting?
I think these his 80,000 plus 10,000, that's 90,000, could be divided into the 9 schemes which I read out. So 10,000 each.
Tony, thank you so much for sending us your question today. And if at all you've missed anything, the show goes on YouTube, channel YouTube. You can maybe look at it once again over there. All right, we move on. A penny saved is a penny earned, but owing to inflation in the economy, the value of the penny saved could be much lesser than when it was earned and saved. Therefore, it becomes essential to understand the effects of inflation on savings and investments. Even more important is to invest in savings and investment plans that can help you keep the inflationary effect on your income in check. So, Feroz, first question, having inflation in mind is one of the key rules in financial planning while you are aligning your investments with your goal, or even when you're deciding a corpus that you want. But looking at the uncertainty around, do you think we need to reassess or revamp this particular goal, keeping inflation factor in mind? How can inflation actually eat up in your investments?
Yes, Kavita. See, uncertainty is going to be a part of our lives. Inflation is also going to be a part of our life. So inflation is nothing but price rise, mehengai. All those are synonyms to the same thing. And how important is it? This is so important that you can't even begin planning without factoring this in. Let me give you an example. When you are saving money, it's nothing but money stored to consume later. Let's assume I keep 5,000 rupees to buy a shirt. Let's assume this shirt today costs 5,000 rupees, but I don't want to buy all my shirts today. Let me assume that I store this money and invest it well. It transforms itself to 6,000 rupees in a year's time. Now I have 5,000 grown to 6,000. Now if I take the 6,000 after a year and go to the shopkeeper and ask for the shirt, if the shirt is priced at 7,000 rupees, I won't get the shirt. So I was better off buying the shirt rather than storing my money. So it's very important that the money grows at a pace greater than the value or the price of the shirt. So that's why inflation is very important. Otherwise, optically, you will be growing your money, but in terms of its power to purchase the commodity while you've stored it, may not be the right case. So important thing is to make sure that your money grows greater than inflation.
All right. I think a lot of other aspects are there to this particular discussion and this particular topic, but then we will touch upon it once again. We have to really go back to our viewer queries, and till the time I get the callers on phone line, let's just take SP Sivakumar's question, Feroz. And he says that he's invested in IDFC Tax Saver Fund, and total SIP is 56,000, and now he says that he has stopped it after the lock-in period is over, and he is not sure if he should be redeeming this amount. He's asking whether he should be there in this fund or he continues SIP. I think we have Mr. Sivakumar on the phone line with us. Hello, good evening, sir. How are you doing?
I'm fine, madam.
Thank you so much for sending us your query. Sir, any reason you want this money? This particular tax?
No, I don't need that money, but I had a SIP in this fund. After some time, I stopped this fund, and I'm keeping it open for this fund.
Okay.
So what should I do? Whether to book the profit and keep the money and invest in some other fund, or I just wait for that. I know I don't require this money right then.
But do you need the tax benefit?
I had a tax benefit. I'm having.
You already have that in place.
Yes.
So could you tell me your existing portfolio? Because that if at all we want to suggest you a fund, there should not be a repetition.
Okay, I'm having Tata Digital. SIP is going on, and then Canara Ropico Small Cap, and Axis Hybrid Fund I'm having, and Tata Balance Advantage I'm having.
And you also said Mira Asset Tax Saver.
Yes. I'm also having Mira Asset Tax Saver.
All right. Okay. So Feroz, Tata Digital, Canara Ropico Small Cap, Axis Hybrid, Tata Balance, and Mira Asset Tax Saver. What should be his strategy, Feroz?
See, I think Mr. Shivkumar should actually first look at it top down, his portfolio. He does not have several categories which are very critical. Now, for example, having a Tata Digital Fund, which is a sectorial fund, of course, its performance about a year back was very good. So there was huge influx of money in digital or technology-based funds. So those are sector funds. So Mr. Shivkumar, you will have to actually also remember exiting them. So it's very prudent to exit and not have thematic or sector funds in one's portfolio, because exit becomes so much more important. So that's message one. Message two is that you have Canara Ropico Small Cap, which is a great fund. Sri Datta is the CIO. That you can continue. Axis Hybrid. If you have reasonable amounts of money, you are better off separating debt and equity rather than buying a hybrid fund. Of course, there's a little tax change in the budget. But hybrid funds become a little more attractive provided they have more than 35% in Indian equity. Having said which, I would not have an Axis hybrid for sure. You have two ELSS schemes. One is the Mirai and the other one, the Bandhan Tax Saver. If you've already finished the lock-in, I would certainly suggest you exit these, because having an open-ended scheme makes so much more sense, because there's no evidence that lock-in provides more return, because you've already finished the lock-in period and you also have taken care of your section ADC already with other instruments. Just redeem it and diversify into the schemes which are flashing on your screen, because they're very carefully chosen different categories. There are 8 very important categories which you should be a part of before you go on to have the 9th, 10th category like a sector fund. So the schemes are there on your screen. I'll read out to you: HDFC FlexiCap, ICICI True Focused Equity, SBI Contra, Franklin India Blue Chip, HDFC Small Cap, Kotak Emerging Equities, and Kotak Multicap. These are schemes from different categories which can complement each other and support each other, and try and make sure that diversification is true to label.
All right. So, Kumar sir, anything else you want to know from Feroz?
No, madam. Thanks for your suggestion. I'll be certainly a liquid IDFC tax saver fund, and I'll move that money to some other fund here suggested. But
Thank you
I
so
don't
much,
have
sir.
any flexi gap. I thought that it is better to invest in flexi cap also. Thank you. Thank you. Thank you. Thank you, ma'am.
We move on, and Feroz, we have Rishabh on phone line from Bhilai. Rishabh, hi, good evening. How are you doing today?
I'm good. Hi, sir. Hi.
Thank you so much for sending us your query. You want to invest 6 lakhs for 10 years. Any specific goal that's aligned with this investment?
Actually, I have to divide this 6 lakhs into 1.5 into 4.
Okay.
So this needs to be invested as lump sum amount in the mutual fund.
Got it.
So for the long term, I just need in which mutual fund I should invest, and for the long term, so that it will give a better amount of return.
Yeah, so I just wanted to know what is that better amount in terms of corpus. How much do you want to accumulate?
Around more than 1 crore.
All right, so let's just take 1 CR. Feroz?
Kavita, see, Rishabh's expectations are reasonably unfair, because 6 lakhs grown even at 14% will compound to 22 lakhs in 10 years. So mutual fund can only give you a return of 13 to 15%. If Nifty delivered 10, 11%, these active funds have the potential to give you that 2% extra return per annum. So 13 to 14% is good quality return, because today, even if you bought an FD for yourself, you after tax will only get 6% or 5%. So if you're going to get 2.5, 3 times more than an FD return on a post-tax basis, because the taxation is reasonably liberal in equity and in equity mutual funds as well. So I think that's what you can expect. So 22 lakhs is what your 6 lakhs can grow to in a situation where Nifty grows by 10, 11, these funds give you 2, 3, and that's when you're compounding your money at 14%. To get to 1 crore, you need 25, 30% kind of compounded returns, which are not possible in a mutual fund for sure. You can buy stocks, but those stocks can also make your money half even after 5 years. But mutual funds, because of its diversified nature, do not stay below the purchase price for long periods of time. So that's point 1. Point 2, I think that you should divide your money not just into 4, assuming that you also have enough debt allocation in other instruments. And I assume that this 6 lakhs is only for equity purposes. Since you're investing lump sum, there are 2 pointed questions which come to my mind from your perspective, is whether should you invest lump sum today or you should stagger it in a 6-month period. I personally think, since the market has gone through a 1.5 year of time correction, I wouldn't mind investing all 6 lakhs at once, maybe in a month's period, over 4-5 installments in the same month, like June. That's point 1. Point 2, do you need 4 schemes or do you need 5, 10, 15 schemes? Maybe I would say 7, 8 schemes would be more prudent, especially because you're investing lump sum. So the schemes which we read out to the previous investors, I'll have to repeat that, and they're already flashing on your screen. Franklin India Blue Chip, HDFC Small Cap, ICICI True Dividend Yield, Kotak Emerging Equities, Invesco India Multicap, Kotak Multicap, Invesco India Small Cap, Kotak Multicap. These are some of the schemes: HDFC Flexi Cap, ICICI Focused, SBI Contra. So these are 9 schemes. You can divide your money in those 9. Be rest assured that 2-3 of them may not be the best schemes, but the other 6-7 will make up for the bad ones. And nobody can choose all schemes which are going to do well. But this is more prospective in nature rather than retrospective, the research.
Rishabh, thank you so much for sending us your query, and I hope you've noted down the name of the fund. Just in case you missed anything, you can watch the show on the channel's YouTube and again get the detailed list of your recommendation. With that, thank you so much, Firoz, for being on the show and helping our viewers with their financial portfolio queries. And time to sign off, but I'm going to leave you with our WhatsApp number and email ID where we keep waiting for your queries. Anything related to your mutual fund or your insurance coverage, the money show at etnow.tv is the email ID, and the WhatsApp number is 865-797-4571. Thank you so much for watching. Goodbye.